Welcome to the Innovation Conversation, a podcast about innovators, both in business and real life. Hosted by myself, Ricardo Pascual, and Harry McDonough.
This podcast is sponsored by OpenExperts.com. OpenExperts is a place to go if you're looking to talk with top experts from around the world. That is open-experts.com. This podcast is also sponsored by startupnetworks.co.uk. Startup Networks, it's an online forum where you can find all the resources you need to run your startup. From grants to investors to tips and tricks on how to be successful in your startup. Today, we are talking with Nathalie Schwarzkopf, an investor from Blackfin Capital Partners.
Hi, and welcome to another episode of the Innovation Conversations. Today, we are joined by Nathalie Schwarzkopf, an investor from Germany. Nathalie, welcome.
Thank you, Ricardo. Thank you so much for having me. It's a pleasure to be here. Yeah, so I work at Blackfin, and we're an investor or a fund dedicated to financial services. So we follow two different strategies. We have on one side a DE buyout strategy where we do majority investment in profitable companies, and a VC side of the strategy where we invest minority. So sorry, can I do it again? Minority stakes, where we take minority stakes in companies. And yeah, I'm part of the VC strategy, and we invest in European headquartered fin and insurtechs from Series A onwards, so ABC, with initial ticket sizes from 5 to 25 million. I'm based out of the Frankfurt office of Blackfin, though we also have other offices in Paris, London, and Brussels, and also recently opened an office in Amsterdam.
Interesting. So the athletes, let's start on is how do you get started in this? How do you become an investor? How do you join Blackfin?
Well, I think my journey was into VC was rather serendipitous. So in high school, I'd already gained my first entrepreneurial experience, being involved in two voluntary startup projects in high school. So for one of them, my team and I actually got promised 100,000 check from a research institute in Germany to build up a lot. And it was a kind of a Google Maps for airports and train stations with various discounts that you can see directly on the app, and users were able to see how long it takes them to get them to their gate and see the real-time information as the time to boarding. And our idea actually got introduced by various airports a few years after we won the competition. So it also kind of proved that there actually was a need. But however, we decided to focus on continuing our high school studies instead of dropping out of high school, which was not really an option. And also during my high school, as well as after it, I spent some time in Asia. When I was 14 years old, I went to a local boarding school in Shanghai. And after my high school, I did a 2-year training program in Hong Kong, which was an extremely valuable personal experience. It also shaped me in many, many ways. After my time in Hong Kong, I decided to finish my university studies in business, which I did in the Netherlands. And I was also spending half a year in Santiago de Chile. After my university studies and my graduation, which was in the middle of COVID in 2020, I had an offer to work in a small international team with very experienced and smart people, working on projects in the financial services area, mainly for a former senior MD at a large private equity company who was appointed as CFO to the board of a formerly state-owned German bank that was acquired by his PE company. And also together with another senior executive who was one of the first ladies in the board of a German financial institution. And they kind of were mentors for me, and I gained a lot of knowledge on the European banking market, but also on FinTechs. Also during that time, I was able to develop my coding and modeling skills and sharpen them even further, which became super handy, for my current job in VC. Also during that time, I was speaking to a lot of fintechs, kind of more from the client or acquirer perspective. Yeah. And I realized that I really enjoy this kind of mix of analytical and personal skills of the job. But to really make impactful decisions that are based on how much work we put in, I thought I really have to go into VC. So that's how I got into it 1.5 years ago, and I'm really enjoying it a lot. And I think also what fascinates me a lot about this job is that you get exposure to so many brilliant and smart founders with so much experience on it, and so many like brilliant ideas like on a daily basis. So yeah, this is what I really enjoy. And also my team members have an extraordinary depth of knowledge in this space. So yeah, I'm really grateful to be kind of in this space.
It's an interesting story because it feels like you've, I should say, you kind of started applying for the job when you were in high school, right? Because everything kind of led to this moment, so it's pretty cool. I was going to ask you because obviously I know there's a lot of criteria when you're looking at investment, potential investment. So what are the key things that you can tell me right now and say, you know what, I always look for these things when I'm looking at a company?
Of course,
Like
like
the startups, or is it like the financials, or a combination of these two things, or something else?
so I think like first of all, I mean we're looking at the fin and insurtech space, which is already kind of a focus space like in the whole startup world. So everything that is kind of related to that segment would actually qualify as kind of in scope. And within our scope, we kind of as we invest in from Series A onwards, we have to speak to a lot of founders which are actually also like in seed or pre-seed stage. Also to kind of already build the relationship from early onwards, and but also in that stage, even though they're quite like a little bit too early for us, we still look at some things, for example, like the traction, or also like what's the ARR development, how the cost efficiencies, like is the company like burning a lot, or is it rather like cost conscious? That's something we particularly look at. But for example, if the company hasn't reached the traction that are kind of desirable for us, I would say like the sweet spot of Series A is around like 1 million annual recurring revenues. If it hasn't reached that kind of KPI yet, or 1 million yet, but has signed a large client for like in B2B space, because we are focusing also like a little bit more like on the B2B side of things, then they would still qualify. But I think it's kind of a combination of different factors that lead us to invest in companies. I think certainly the criteria has become, like for founders to raise, have become slightly harder in the past 2 years than in 2021. So kind of seeing your traction and customers that they were able to sign has become more important.
I was about to ask you, sorry, just about to ask you something.
It's always a combination of different things. Team is also quite important for us. So then the team is able to also progress to the next stages. Because I think Series A is a kind of in between, like the very early stages, but also like in the growth stage. So the founder needs to have certain skills that are kind of good for the early, but also like for the later stage. So he needs to adapt to the market situation well.
I was going to ask you, how do you differentiate the hype? Like, I was looking at the story of Cleanwork, and you got to a level where they had a crazy valuation, and there was a lot of hype behind it, right? But their financials were just completely not there. So how do you set that apart when you're looking at a company? You might need a founder who is very charismatic, has a lot going for himself or herself. But how do you actually say, you know what, I just looked at your financials, and actually I don't want to invest because it doesn't add up. So did you ever come across companies like this?
I would say we don't really invest in companies that are super hyped. Of course, you see a couple of business models, for example, like AI, which has been quite high in the last few years. And I think also like these companies, they don't really have a lot of like problems with raising right now. If you just look at Mistfall, which was just closed around, I think at the end of last year again, with a crazy valuation. And also like I think in the climate tech space, there are also a couple of like hyped companies. But yeah, I think we kind of since we invest in the rather later stages, we don't really focusing on only the founding teams, and we wouldn't invest like in just the hype because also kind of the financials are too important also for us, and so that's why but I mean there's always been these crazy companies that are raising large amounts, and I think it's probably something more for other VCs, but for us, we kind of also have like since we have this knowledge on the market and of founding members who have been in the financial services area for many, many years, and also kind of experienced like all the different crises and heights, they're more like sensible when it comes to investing in super hype deals.
On that note, when you look at all these companies, because I know your spectrum is very much European, do you notice any big difference between the countries in terms of the way they do things, or not really? It's pretty much all very standard.
I think the market picked up quite much in the UK and in France. That was at least my impression, and we also kind of track the deals each week that happen like in the fin and intercheck space. So if you're interested in that, of course you can subscribe to our newsletter, and we also like always post it on LinkedIn. But I think it's also like very interesting for us. So we always try to kind of use the statistics for our own kind of knowledge, and we have to compare like the rounds that are happened like over the last few years, but also in the different regions, and you can clearly see that the UK is kind of an outlier in that sense. Germany was rather more conscious in the last few years. There were a lot of like bridge rounds last year as well, or internal rounds. But I have the feeling that it's picking up in Germany again. So you see a lot of more like investable companies. And my feeling was also that a lot of these companies, especially in Germany, they managed quite well, like over the crisis, with this continued focus on profitability. But I'm curious to see how the market evolves like over the next few months.
But correct me if I'm wrong, it's slightly more complicated to start a business in Germany than it is in the UK, right? Because in the UK, you go online with a company with followers, but in Germany, you actually need some capital to get started, and then it's a fairly more complex process, right?
Yeah, that's true. That's true. So in Germany, for a lot of things, you still have to go like to the kind of registry office to get papers signed by the specific authorities, whereas in the UK, much more is like digitalized and easier in that sense.
You notice any difference in the size of the rounds? Because I know you're expecting it's in European, but do German companies tend to ask for a higher round in comparison to the UK ones, or the other way around? Or how does that work?
I wouldn't necessarily say so. I think I have to look more into it. Sorry.
That's all right. It's not an interview. I mean, it is technically an interview, but it's not like a job interview, so it's we're really talking about those things. So I wanted to ask you about, obviously, I know you travel a lot. I know you have traveled a lot. Which countries, let me rephrase that, comparing Europe to the US, what are they doing differently? Because obviously the value they create in the global economy is much, much higher. So why do you think that's so? What sets them apart?
I think the US investors and also startups are way more risk-taking than the European ones. So, I mean, they also, still you can see it like in the growth round. So, American investors, they still want like a large, kind of growth with extreme burn costs. Whereas the European investors and the whole market in Europe has become more like towards, kind of building more like a sustainable market and businesses. But I think that's probably also because of the mentality in the US, and also maybe history-wise. And since there's also a lot more guide power to deploy in the US, so kind of they're focusing more like on this approach of getting companies started. And if you don't succeed, then you start all over again, and do it in a different way. Whereas in Germany, you try, or like in other countries in Europe, you just try, and if it doesn't succeed, then you try to adapt your business until it works, but you don't fail completely in that sense. Kind of you pivot a lot, but it's a kind of different also mentality of people.
I have to ask you this question, right? Because you're on the receiving end of a lot of pitch decks, a lot of outreaches from startups. Now, what's the best way to reach out to an investor? Because there's a lot of software out there that kind of helps you reach out to investors. There's a lot of gurus that tell you, oh, do this, do that, and there's also this hyper-connect with people. So, what do you think is the best way to, as an investor, to receive a pitch deck, but also for startups to say, I want to reach out to them. This is how it normally works.
I think the best way is always to get like a warm introduction from another investor or someone that you meet at an event, because then you can also like maybe see if the founder. Sorry again. So I think the best way is always like to get a warm introduction by like another investor, or it's also very valuable if you meet people like at events, because you already get a sense of the person, and if he's able like to manage like kind of investors and the company. And since I think the job is also very much on like deciding on kind of but I think it's also okay if founders would just reach out via LinkedIn, maybe like tell a few things about their business, and why you should have a look at them. That's also like a good way. So I think it's not the best way. I think it's always certainly kind of a bit weird to get cold outreaches by founders, especially if you have the feeling that they don't really had a look on the website of us, what we're doing. Since we're focusing on fin and insurtechs, we probably won't look at a gaming company or something like kind of in the e-commerce space, which is not related to fintech. So I think you should also like know who you're kind of reaching out to. So
you get background research, and when you do reach out, make sure it's highly personalized.
Exactly.
So it's relevant for us. Yeah, I think that's the issue, is we actually met through my very pragmatical shotgun approach, where I emailed thousands and thousands of investors. So probably not the best way to do that. It's always interesting to know this, because I know that a lot of investors get a lot of pitch decks, and it just kind of overflows their inboxes, right? So it's not the best way to do that. So interesting. Okay, so in all these markets, where do you think the investors are less risk averse, so they're more willing to gamble with their funds? And this is a bit of a trick question, but where do you think they're more likely to say, you know what, you want another million, here you go, just let's see how it goes?
I think it's currently, I think I already touched upon it a little bit, but I think in the AI space, because for most cases, those are really solutions that improve the efficiency of processes. So they really have a significant value add for companies, and are able like to sign probably also a lot of companies. And so this is already a good sign for investors. Also, these solutions also tend to have a healthy technology. So doing diligence on that specific area probably also turns out well. And also like normally if you're building like an AI solutions, you also need to, as a founder, need to have like some technical skills. So in that case, you would also tick a box in that sense. Since it's quite high at the moment, and everyone kind of wants to invest in that area. I would assume that investors probably don't have that many harsh criteria in that area. And it also goes for climate tech, fintech or startups, that I had the impression were also not so much affected by the market cool down. And here's a lot of corporates here, and it's here as well, have ESG on their agenda, and they really have a continued interest to fulfill the ESG goals. So therefore, it goes along with that investors probably also have these ESG agendas, and therefore, probably, just invest in companies in that field.
So would you tell for startup, stop what you're doing, just build me something that has AI and the climate tech or something like that, or some ESG in the middle, because we know that you're gonna get investment one way or the other. Would you say that to a company?
Not really, because I think it also depends on so many other like factors. Also like who the investors are, how the market is at that time. And I think also like, I mean, if you're building something now, you're probably like the chances are that you probably have to change it before you sell at quite high, because the market when you're probably want to sell or IPO is a completely different than the one that you're building for now. So therefore, I think it's quite important also like to be like close to the customers and act flexibly on the changing market conditions and need. So therefore, I probably wouldn't say you should go to that area, but also like listening close like to your customers and observe like what's out in the market right now. And it's currently, it's for now, like it's a trend for now, but we don't really know what the trend will be like for a couple of years in time.
Yeah, true. I mean, I was looking at, I was talking with a couple of people looking at success on AI, and the value it's going to bring to the world economy, it's through the roof. It's actually amazing. But then you cannot help but wonder what's the downsides. I mean, are people going to lose their jobs over this? Which I'm sure they will. A lot of people lose their jobs over this. And also, like, how impactful is this going to be, the whole AI implementation? So, it's going to be in a very exciting space to be in, I think, but also it's going to be moving, right? There's a lot of that. For example, let's see the companies that do this, take a picture and then the picture changes, and it's want to look like a pirate and then become a pirate and stuff like that. And if you just really start doing that it might not affect that well, and it might not grow that well in the future, right? Because it's very limited what it does.
Exactly. Mm-hmm.
Yeah, for sure. How much, like, when you look at the fintech space, how ripe is it for disruption? Because it's traditionally a slow-moving space, isn't it? Because, banks, for example, they're not very quick to adopt the technology. So how ripe is it for disruption overall?
I think it depends also a little bit on the sector or the space. So I think some areas, for example, like in the compliance segment or like KYC, KYB space, there's still a lot of potential for disruptions. I looked at the market way more in depth last summer, and I had the feeling that still a lot of processes are done very manual. So for example, like to do like a KYB check, you really like need to go like to the bank, introduce yourself, and then copy of your password, and then the bank kind of does a check. But I think here you can really like bring a lot of innovation in the market, also with AI or automation. So I think therefore this is a really interesting segment, RegCheck. We also following it quite closely. And there's certainly other areas like which have typically which were served by large corporates before. But now I have the feeling that the trust in fintechs is more established than a couple of years ago. So, for example, we were also looking at one sector like in the supply chain financing area. And my feeling was that the companies in that sector were, or the fintechs were competing only with large banks in that sense. But the fintechs that were around it were already like over 10 years ago, 10 years old. So yeah, and banks were more and more willing to collaborate with them because they now reached a certain size. They reached certain clients. They tested the solution, so the technology was kind of solid, or is solid. So there's much more acceptance on fintech players in the market, which I think brings a lot of value. And therefore, there's always room for innovation in the market and disruption. Yeah, so curious to see which area is the next.
You touched upon something quite interesting, which is banks traditionally they won't want to do business with an early stage startup, maybe Series A startup. How do you get past that and how do you build trust with, for example, bankers we talked about the person speaking to? Well, how do you get past that stage where your clients will be very large institutions? Well, how do you build that trust with them?
I think first of all, the most important thing is that your solution is actually working. And if it doesn't work, that you as a startup, you find a solution like to make it work. And if you have continued good feedback of clients, then I think it's easy to also sell other corporates. And I think in the past, a lot of companies were focusing first on the mid-market segment or small and mid-market segment. And then we're working their way up to large corporates. Because then they reached and if a certain size, they became interesting for corporates. So I think now it's changed a little bit. So some companies are already targeting large corporates. But I think that's a thing that you need to kind of make sure that you also have interesting partnerships, which is also a good way to get into to sign corporates in partnerships that are relevant, where you can able to demonstrate that if they already sign you or they suggest you, then the solution will work and will kind of improve processes for existing solutions or will actually be something innovative.
Well, I was wondering about something else. I was reading a post the other day on LinkedIn, and some random guy was bragging about how he gets thousands and thousands of pitch decks every year, but he only looks at 0.01%, right? And that made me wonder. Obviously, he was being a bit of a class act. But what does that process look like from your side when you get a pitch deck? How many people actually look at it? Is there do all pitch decks get looked upon or not really? Who looks at these pitch decks? How does that process work on the other side?
No, so I would say that we look at all of the pitch decks that we receive. Depends a little bit on which channel. I think on if I receive one on my personal mail or on my LinkedIn, then of course I will have a look at them. If it's on our kind of company, sort of email address that which is for everyone, then I'm not sure who would look at it. So it's always better to send kind of the emails to the right people. And so at Blackfin, we also kind of divided into different regions, and also I based in the specific region. So I'm based in Frankfurt, I'm covering the whole Germany, Austria, and Swiss market. And colleagues of mine that are based in the UK are covering, of course, the UK market. Other colleagues who are in France, covering France, obviously, and or in the Nordics and Southern Europe, or Benelux. So usually it's the people who are responsible for the region who will look at the deck. Yeah. And in the deal team, there are normally 3 to 4 people, I would say. But it depends a little bit on the segment. So for example, in our team, you also have some experts So for example, I have one colleague who worked in the fund administrator sector for a couple of years. So she's kind of the expert on all topics that are related to that. So if we would see a deal in the next days, we would always ask her like for some advice. But sometimes it's also just me who look at the pitch decks, and if I found the opportunity interesting, I also like to push forward and have a first call with the founders. And if the call was positive and I like the opportunity, I usually present the opportunity in our team meeting, like every Monday. And then, kind of with a one-pager on the company. And with my team members, find the opportunity interesting. We would go further and dig more deeper into the company. But this is
How many pitch checks do you get on average to analyze? I know it's
I've never counted them, but I think I would say I would speak to.
Right?
I mean, it depends a little bit on the weeks, because I think no week is kind of the same as the other, and no day is like the same as the other. But I think I will speak to, I would say, like 4 to 5 companies per week. Sometimes more, sometimes less, of course. And the pitch decks I will probably receive. I mean, it depends a little bit, because like I also do a lot of like cold outreaches to founders, or if I see a company that I'm interested in speaking to, but they're not raising, they probably don't have a pitch deck. So I just collect like notes of the meeting, and that will kind of also like serve as a kind of basis. But maybe pitch decks I received over the last 3 years were probably like, maybe I would say on average maybe 3 per week. So often I get them, and then I don't really find the opportunity interesting, so I'm not taking the call usually a pitch deck. But I think people know that we kind of also like Series A investors. So I guess that seed investors probably getting a lot more pitch decks than us.
I can imagine it must be crazy for a seed investor to get that many pitch decks, right? Because everyone wants to start something. So it must be absolutely crazy. On that note, do you use any software to analyze the pitch decks? Because now there's a lot of AI solutions that just break down the whole thing and say, oh, this is good, this is not good, based on A, B, and C. Like, do you use any type of AI solutions for that, or it's still very much a random process?
Not so far. I mean, it's quite a manual process. I think there are certain things we look at to assess whether a company is interesting. So, first of all, of course, the product, then the traction, if they have a slide on that. Typically, they have, like, from Series A onwards. Seed stage, it's not so common, I would say. But also go to market or sales channel. But I think it depends a little bit on the segment we're looking at. But I think product, to understand it better, and also like the fundraising deck is also something that we find particularly interesting. At least.
But, if you have one advice to give to founders, what would that advice be?
And I think it's really important in the end to kind of understand the environment as you're in as a founder. And I think it's also crucial like to act flexibly and with us like to the customer needs. I think also like in terms of deal terms and valuations, I think founders should not go for the absolute minimum dilution. Trying to get to some crazy valuation. So they should rather anticipate in parting with 50% to 25% of their company in typical. So kind of not doing these crazy competitive rounds. And I think also one thing that founders should expect is, especially like in early funding rounds, is a clean term sheet without like burdensome veto voting rights or multiple liquidation preferences. Because it could really like kind of become like a something which could obstruct the later rounds as a founder. And I think also what is important for founders is they should account for more time and for more runway when raising money. So I think the time also like to raise a Series B round. I read a statistic from Carta has grown to 85% over the last 3 years. So yeah, you should rather raise when you still have money and not when you have to. And I think really you should try to be close to the customers, really understand the market they're in, and building alongside them, understanding their needs. Because I think those companies who followed this approach also like in the last 2 years, they are the successful ones. And I think the startups that are in trouble now are the ones that wanted to build their product like fast and scale really fast. And also were able like to keep their costs like under control. And another really important thing, which is also quite crucial like for the fundraising process. As a founder, I think you should really like focus on building investor relations early on and also update interested investors on a regular basis, because then you don't really spend too much time during your fundraising process to explain your product and business all over again. And my impression was also like when speaking to founders that they really want to raise with more specialized funds. I'm not sure if it's a bias because, like I'm focused on fin and insurtechs, but that's a feedback that I continuously hear from founders, that they're really looking for someone kind of who brings like a strategic angle to the company. That's both my matters.
It's essentially because you mentioned something that I wasn't aware of, that it's actually not much harder, but the market's also slowing down raising Series A, B, and C. Like, why is that happening? Because everyone's complaining about how slow the market is, how hard it is to raise. I thought Series A's would be like, you made it, so we're safe now. But actually, you tell me it's the other way around. It's actually quite hard to raise now. So why do you think that is? I mean, is there anything you can do to change that?
Yeah, I think it's something that probably you can see like in every stage. I think like in the past, like especially in 2021, which was definitely not a year like to compare into to this year, the valuations were extremely high and not sustainable. And the ones was like super big and kind of bigger and better, but not necessarily better for growth and sustainability. I think like it changed a lot like in the past 3 years, I think because the valuations are down, the KPIs that investors like to see also become more straight. And I think this is also linked to capital costs that are now significantly higher than in the last decade, which means that it obviously becomes more difficult to raise. And so, like since the investment market orientates itself like on the interest rate market, and we haven't really reached any significant interest level or interest plateau, I don't think that the fundraising market, especially like in the like later stages, changed much because we haven't really seen like the full consequences of the market correction yet. Therefore, I think if the capital cost or the interest level, if they don't really kind of change significantly in our favor, then it probably won't change that much like until 2020. But I think, yeah.
So there needs to be a reduction in the interest rates. That's the key thing.
But on the other side, it's not necessarily a bad sign, I would say. If you look at just as the vintage years like after the dot-com bubble or the financial crisis, you see actually that those years were super formative, meaning that those years also brought a lot of innovation to the market and brought very strong innovative companies. And also, like if you look at the fund performance and the returns of VC firms, which they were able to achieve during those years, it was one of the strongest years in venture capital. Yeah, therefore, I think it's now a good sign. There's also this saying that you always should act like counter-cyclical in that sense. So therefore, I think now it's a good time to found a company, but also to invest. And I mean, despite like these kind of obtaining capital costs are harder, which I mentioned earlier, but there's still lots of opportunities. And also the last year, 2023 was actually really good for us with Blackfin. Like we closed our second fund of 219 million, and we invested in 4 really, really good companies. So
Well,
yeah.
it's interesting because you mentioned the last financial crisis, and I don't think some people are aware, but companies that we now use on a very regular basis were actually founded back then. Airbnb, Uber,
Exactly.
Deliveroo, Just Eat, all those companies were founded there, and they were having the same difficulties accessing capital that you do nowadays. So you're right; it's 100% the time to go is now, right? To start now because you're much more likely to be successful than to wait for the good times to happen. So yeah, definitely. If people want to reach out to you, how can they do so?
Please reach out via LinkedIn. Maybe you can link my name in the show notes. It's Nathalie Schwarzkopf, or reach out directly in my email. It's Nathalie.Schwarzkopf@blackfin.com. It's happy to hear from you guys, and please send any decks if you have them. I'm happy to have a look at them, and
Awesome. Nathalie, thank you so much for your time. It's been very insightful. Thank you.
Thank you also. It was a pleasure to meet you.
This podcast is also sponsored by startupnetworks.co.uk. Startup Networks, it's an online forum where you can find all the resources you need to run your startup, from grants to investors to tips and tricks on how to be successful in your startup. This podcast is sponsored by openexperts.com. Open Experts is a place to go if you're looking to talk with top experts from around the world. That is open-experts.com.